Welcome to the Explainer. Today, we're going to dissect a single high-stakes options trade to really see the invisible forces. You know, the gamma squeezes, the algorithmic wars that can push a stock right to its breaking point. You've probably heard this phrase before. It's how people often describe selling options. You see, it's a high-probability game, but there's this catastrophic risk just lurking out of sight. We're about to see exactly what that steamroller looks like and just how fast it can really move once it gets going. All right, let's dive in. The trade is what's called a short strangle on the stock SNDK, which was trading around $772 a share. And put simply, a short strangle is just a bet that a stock will do, well, pretty much nothing. It's a bet on calm, right in the middle of a gathering storm. So here's how it's set up. It's actually pretty simple. On one side, you sell a call option way up at $11.40. That's your ceiling. On the other side, you sell a put option way down at $400, creating a floor. The entire bet is that the stock will just bounce around inside this incredibly wide range, and the trader gets to keep the money from selling those options. Now, on the surface, the logic here seems totally sound, right? I mean, these prices are almost 50% away from where the stock is trading. But the real danger isn't the price actually hitting those numbers, it's the threat of it. With an implied volatility of 98%, the market is basically pricing in chaos. And that means any big price swing, even if it never gets close to your strikes, can cause massive paper losses because of something called vega risk. Okay, but here's the thing. This stock is not staying still. It's being moved by these powerful, unseen forces, and it all kicks off with a tidal wave of trading volume. It's the first clue that something big is brewing right under the surface. This chart tells a classic story. We're seeing what's called a price-up, volume-up pattern. This isn't just random market noise, folks. This is the footprint of large institutions. We're talking the big money piling into the stock because they are absolutely convinced it's going much higher. This is that first hidden force making its move. And look, if the stock volume was the kindling, then the options market is where someone just dumped a whole can of gasoline on the fire. On one single day, over 172,000 contracts changed hands. That is an explosion of speculative betting that is about to kick off a really powerful feedback loop. So this explosion in options trading triggers something known as a gamma squeeze. So how does it work? Well, every time someone out there buys a call option, the market maker who sold it to them has to go out and buy the actual stock to hedge their own risk. Now, imagine thousands of people doing this all at once. This forced buying from the market makers creates its own momentum, and it pushes the stock higher, which then forces them to buy even more stock to stay hedged. It just becomes this vicious, self-feeding spiral, pushing the price up and up. So you've got this absolute firestorm of buying pressure, and now it turns its attention to another group, the short sellers. These are the folks betting the stock will fall, and they are about to become the rocket fuel for the next big move up. Here's the huge problem for anyone betting against this stock. A pretty big chunk, 7.5% of all available shares are sold short. But at the exact same time, a massive 82% of the stock is locked up by big institutions who are not selling. So this creates a major supply crisis for any short sellers who are trying to buy back their shares to cut their losses. The result, a staggering $3 billion in losses for anyone caught on the wrong side of this. I mean, the risk has gotten so insane that a major analytics firm, S3 Partners, flagged the stock's short squeeze risk as being in extreme territory. That is a bright red, flashing warning light that the conditions are absolutely perfect for a violent, explosive move higher. And all of this creates a phenomenon people call a rolling squeeze. It's kind of crazy. As the first wave of shorts gets crushed and is forced to buy back shares at a loss, which, by the way, pushes the price even higher, a brand new group of traders sees this high price and decides to bet against it. They think, hey, this is a can't-miss opportunity, but they're really just stepping in to become the next wave of fuel for the fire. So now the stock is at all-time highs. What does that mean? It means all the old price charts are basically useless. There's no past resistance to look at. Traders have to find a completely different kind of map to figure out where this runaway train might actually be headed. This is what traders call price discovery. Seriously, it's like you're sailing in completely uncharted waters. All the old maps are worthless, so you've got to find a new way to navigate. And that leads to the big question, right? For a lot of them, that new map is based on Fibonacci extensions. Now, this isn't some kind of magic. It's just a tool that takes the size of a stock's last big price move and projects it forward using these key mathematical ratios. And because so many high-frequency trading algorithms are programmed to follow these exact levels, they often become self-fulfilling prophecies. And on that map, there's one number that matters more than any other, the 1.618 extension. They call it the golden target, and it acts like this powerful technical magnet, just pulling the price towards it. And what's really scary is that it sits dangerously close to that big $1,000 psychological barrier. Okay, so you've got all of these massive external forces, gamma squeezes, short squeezes, algorithmic targets, all conspiring to push the price higher. The final battle for our trader, it isn't happening on the computer screen. It's happening inside their own head. You see, to stay calm in this kind of situation, a trader has to completely shift their perspective. An amateur looks at the screen, sees a big, flashing red number, and just panics. But a professional, they ignore the dollar amount. They look at the underlying mechanics, the Greeks, which are just variables that measure all the different risks, and they make a cold, calculated adjustment. Look, professionals don't just improvise when they're under pressure. They have a preset playbook to keep them from that paralysis by analysis. They limit their choices to just 3 core defensive moves. They can roll the option out to a future date to buy more time. They can adjust the other side of the trade to bring in more cash, or they can buy a little bit of the stock to temporarily hedge their risk. That's it. And this right here, this is maybe the most important mental shift of all. A professional does not see a losing trade as some kind of personal failure. They see it as a business expense. It's just a predictable cost of doing business. And thinking that way, it completely removes the emotional sting and lets them make clear-headed decisions. It all comes down to this one simple mantra. It's a constant reminder that in all the chaos of the market, the only thing you truly have control over is not the stock, but your own pre-planned, systematic response to whatever the market throws at you. So what's the big takeaway here? It's this. The market is always going to be chaotic. It's always going to be driven by forces you can't control. But having a solid, predefined plan, that's what separates a panicked reaction from a professional decision. It's not just a strategy. It's your armor.